here.
Hey, and this is Kisa.
Hey, so we got a good signal. We're ready to go. Let's dive straight into it. All right. So this is a credit analysis we put together, and we're just gonna go straight over what is credit and how does it affect you. So what a low credit score costs you? Let me see. Let me share my screen so y'all can see. We're gonna get into this credit analysis. All right. And you should be able to see us, but you can't see us, but you can see the screen. All right. So what a low credit score costs you. This is a brand new Toyota Camry. Don't know if it's the loaded model or what model it is, but it is $23,000 with a 66-month term. So that means person A has a credit score of 730, person B have a credit score of 599. So as you see here, person A gonna get the best interest rates depending on the market, and gonna have a favorable payment versus person B. They got the worst interest rates based on their scores, and the down payment is not so favorable. And this is all because of a 131 point difference. So as you can see, over 66 months, the person with the 730 credit score who got approved at this time will pay only $1,300 in interest. And person B who got approved will pay $10,921 in interest. And I said this to say, when you're thinking about retirement and your future and your kids' future, you are taking away from them when you pay so much in interest. If you was to do what it takes to get your credit where it need to be at before you go spend your hard-earned money to get things, you could save money, just between interest. This is almost a $10,000 difference than what this person is paying, all because their scores are below what is good credit. A low score can cost you $9,616 more for the exact same car and price. And as you see right here in small letters, the same thing happens when your credit cards, mortgage loans, and etc. So Kisa, she's going to go over what a low credit score costs you when it comes to buying a house.
All right, so that's when you will see it's a big difference as far as the number, numerical amount as far as cash. So person A with the 730, they have an interest rate on their home mortgage of 2.75%, which makes their monthly payment on their mortgage loan $1,021. Person B have, let's say, $599. Interest rate is 6.5%. That is a big difference when paying interest on a home. Payment monthly is now $1,580 versus $1,021. So for one, you're paying a higher monthly mortgage on this exact same home just because of your credit is lower. And then the total interest paid, well, I'm going to use their name, Jane's credit score. Total interest paid is $117,417 versus John, where he would pay almost $318,861. That is a big difference. So the total payment, as you can see, John's deserve to be in red because his is such a big difference. And that's a lot of money. Like Zeb said, when you think about retirement and your kids, that's money that can be for you. So just take the time and get your credit score where it needs to be. Then go get those items that you desire.
And I'm going to tell you what I love so much about this. So many people say, well, I can get approved with a 620 credit score to buy a home.
Yeah.
Yes, you can. But you have to think, these are 30-year mortgages. That is 360 months. That is more than half of your lifetime. So with that being said, if you're going to tie yourself into that type of mortgage, at least do it with a lower interest rate versus a higher interest rate because the prices for the payments will change. And we're going to dive more into that with the next slide, but the prices on the payments is going to change. The total interest paid over 30 years will change. Like many people are not going to double up their mortgages. And as you see, a lower score would cost you $200,000 more for the exact same home and price. So yes, that's why we emphasize cleaning up your credit because this will help you out. It will help you save lots and lots of money. So how do the credit bureaus determine your credit score? Let's see. How do they determine your credit score? The credit bureaus determine your credit score by this very unique pie chart. 35% is payment history, 30% is the amount of money you owe, 15% is the length of credit, 10% is the new credit, and the other 10% is the credit mixture, how mixed your credit is. So when you think about the first percentage, the first pie chart, the first slice of the pie, the biggest slice, you got to ask yourself, do you pay your bills on time? Because it's your payment history. So if you have paid your bills on time, that will help your credit score 35%. But if you have collections or bankruptcy or just a late payment, that will hurt your credit scores 35%. Do you have long credit history? This is going back into that 35% plus 15%. So now we're looking at 50% of your credit score. If you got long credit history, is it good history or bad history? All that matters. Have you ever applied for credit recently? What have you applied for credit recently? What is your outstanding debt? So to go and make this a little more simple for people, 35% of your payment history means how you pay your bills on time. 30% is how much money you owe. So people who get large credit lines are working on 30% of their credit. If you're starting off and maybe you only can get $500, well, that's good. But if you could eventually get an increase and turn that $500 to $1,500, that would be even better because the bigger the credit line, the more money you will owe, the better your score will be. Now you're working on 30%. And the rest of these, they will come as you go, but these are the main two to focus on. So let's go into our slide for the day. Let's go into the slide for the day. It is buying your home in 2023. Home sweet home. That is a nice home. And y'all can still see us. So any questions, definitely drop them. Let's see what we're talking about. And let's get into it. So important notes. Let me know if this slide is not looking right for anyone. Look pretty good on my end. Okay, yep, y'all still can see us. So important notes. Okay. So what we're about to teach you is very useful. So take plenty of notes. This is not credit repair, only home buying. So we're only teaching you what you need to do to buy a home. Do not skip any steps. We have helped hundreds of our members get their first home. And you got to make sure that you're neat. Be very neat. This will determine a lot between success and failure. Okay. Oh, can you see this? Can you see it?
Okay. All right. So let's talk about getting your credit pulled by 3 lenders. So when you apply for a mortgage, the first thing we do recommend is for you to get your credit pulled by several different lenders. And here's why. One inquiry only counts against you, meaning your credit can be pulled during a 14-day period and only one inquiry count against you, making it easier to shop rates without affecting your score. So we do recommend at least 3 quotes. That is the ideal number. And here's the ideal lenders to use for your loan rates and costs. So first, always go to your local bank. Don't dismiss them. Just go to your local bank. That's who you are probably the most familiar with, and they are familiar with you, and you've built a relationship. Oh, and that's what it says. Okay. Your local credit union. Make sure you are with the credit union. Good credit and good banking relationships do go a long way. Your local town mortgage broker with good or decent credit brokers can help you get into your homes a little faster than some banks, which is very true. They may be able to do 60 days versus 90. So that is a good option for you. Loan Depot, One Trust Home Loans, Quicken Loans, etc. The pre-approval letter is a conditional commitment by the lender to provide financing for the purchase of your home. Having this letter will let the realtors know that you're serious and also you're qualified. Plus, most realtors will not start showing you houses without the pre-approval letter. So your pre-approval letter basically just lets the realtor know and you know how much house you can afford, so that you won't go house shopping for a home that's out of your budget. You already have that in line.
Okay. So let's get to the next one. Breaking down what happens after you get your credit pulled. What are lenders looking for? When people are going to go buy homes, majority of the time they don't know exactly what the lenders are looking for. So we're gonna go over some of the things to expect when you go buy your first home. They're looking at your credit reports to see if you have any collection of derogatory items. I'm gonna give you a great tip. If you have collections, you can pay them off and they will omit those items. And the reason why they will omit them is because it does not look like you owe the balance. So when you owe a balance on the collection of derogatory item, that is counted against how much debt to income you have. So that's also added to your debt. So if you have a credit card with a high utilization, which we will talk about, this maybe $300 credit card collection you have will be added to that debt to income. They're also looking to see what your debt to income is. I just said that. So DTI, we will talk more about DTI. Pre-approval letters will allow you to start shopping for your house. Some lenders do not require a credit pull to give you a pre-approval. They will give it to you just based on the information they know about you or what you tell them. But we'll get further into that. Get your pre-approval. Let's shop for your first home, your second home, your vacation home, your Airbnb home, whatever home it is, let's shop. But you need the pre-approval. A lot of realtors will not deal with you unless you got it.
All right, so things that you need to know. Location of your home, the price of your home, the size of your home, and I want to kind of dig into what that means. So not just a size of your home for your now, for your future. Think about if your family will grow, if you want to have a home that won't be too much on you to take care of, because taking care of a home is a lot of work because it's yours. You can't call on a rental company or the maintenance man. You are the maintenance man when it's your home. So think about those things. The year of your home, that falls into the size of your home. So the year of your home matters. You don't want to purchase a home that is old as you are, because that home will probably need some work. It will probably take up some time and cause you to spend additional money, okay? Open to renovations or not, and that falls, of course, next. So if you're open to renovations, fixing things in your home, or just simply do not mind a fixer-upper, they can get approved with a mortgage, then of course you can look into options for homes with renovation. And so tip, buying a home with a pool installed is cheaper than installing one yourself, and that is absolutely true. Having a pool at your home increases your value of your home. But when it comes to, hey, I'm gonna buy a home, then install a pool, that's at least 20 to 60, yeah, 20 to $60,000. Then you got to think about the maintenance of that pool.
And
yeah.
Also, when you add a pool to a home, majority of the time, your spike in your equity in your home, meaning how much your home is now worth, probably won't increase because it's based on the community that the home is in. So you have to think about all that if you want to add a pool to your home.
Yes, definitely.
Okay. Let's get to the next one. Okay, so this is a great topic. Benefits of buying a home versus renting. So this is going to be a very touchy subject. I tell this to a lot of our members, and a lot of them don't get it, and a lot of them do get it. So let's dive into it.
Disclaimer here, guys. Everything that we are saying, we have been through it. We've taken this information, we've learned from it, and we use it ourselves. This is not something that we took off Google or anything. This is like our real life experience, also combined with us helping other people go through the experience.
Right. Okay. So you can make any adjustments and customizations to your home because you would not have a landlord. So that's the benefit of buying. You can do whatever you want to do. My wife said she wanted to paint the wall black. We painted that wall black. You can do those things when you have your own home. Your mortgage payments are tax deductible. If you don't have a good tax prep or a CPA, get one. They will further explain that. But you can deduct your mortgage payments. Mortgages can be tailored to your budget. So depending on how you set up your home loan when you go to buy a home, you can just about make it where it fits inside your budget if you know how to do the process of elimination with debt. Great story about ourselves. So we had a car that we was not using that often that was in a whole nother state. But we had a low car note that was like barely $300. When we bought our first home, that car note determined $80,000 on how much we can afford on the home. They said if you couldn't get that car paid off, because it was a low car note, so it wasn't a big balance on it. But they were like, if you can get that car paid off, not only will you be able to afford $80,000 more in that home, but your note will drop. Or you can take it up higher depending on how you want to do the note. So by just removing that car, because I sold it, basically she was sad, but I sold it because we didn't need it. But by just doing that simple trick, we was able to get $80,000 more into the mortgage that we wanted to get into, and the note did go down, and the down payment money we had to put down went down as well. So
I got over it. I got a nice house.
Yes, we got so many rooms. It's a blessing. Okay, so back to what I was saying. Give your family stability. It gives your family stability. So when you buy a home, you don't have to worry about, hey, we got to move. Like that was Keisha's biggest issue before we bought our first home. It was like, hey, I'm tired of moving every 2 years or every 3 years. I was okay with it, but when you think about it, as your family constantly grow, you don't move into smaller homes, you move into bigger homes. So you have more stuff to move every single time.
And I got out of control.
Yes. Opportunity to make income if you were interested. So with that being said, when you buy a home, you can either live in it, or if you, I'm not going to tell you all something to get you in trouble because I don't want to do that, but I believe by law, you have to stay in that home 2 years, right?
With the first time home buyers program, but with the conventional loan, you don't.
Yeah,
it's totally up to
what you want to do.
Yeah.
But if you're a first time home buyer, which most people will be, if you're using we're using the FHA loan, then you will have to stay in that house a few years before before you can start renting it out as an Airbnb and make money.
Or the workaround to that is if you had a multi-unit property, like a duplex or a triplex, as long as you stay in one of the units, you can rent out the other two to supplement income, or you can just do the Airbnb.
Right.
Like
Airbnb? Okay. The next thing about buying a home, so right now interest rates are high. Don't know where they're going to be in the next year. Really don't care. If you want a home, go buy it. You can always refinance it later and get more money back out of it. You can get a lower note if you want to later. So that really doesn't matter. If you want the home and you can afford the home, go buy the home. Stop listening to what other people are telling you. So renting versus buying. I'm going to get into some of the pros of paying rent. Whether you choose to rent or buy your home depends on your financial situation, lifestyle, and personal goals. Paying rent is a lot cheaper than buying, if you want to believe it or not. Both provide you with a place to live and requires regular income in order to make the payments. Renting offers flexibility, predictable monthly expenses, and someone to handle repairs. So if you're paying rent, as long as you don't have a slumlord, we never one of those before. But long as you have a good landlord, you don't have to worry about repairs. Like those things are inclusive. But when you're buying, you become the landlord. So you gotta have extra money set aside because things are gonna break.
You're your maintenance man.
Yep. But get you a good spouse, is all I can say. Home ownership brings intangible benefits such as a sense of stability and pride of ownership, along with tangible ones of tax deductions and equity. So that means when you own a home, yes, you can gain equity. I like to look at buying a home as having a savings account. If you have struggled with saving money, you should buy a home because you're going to save in it regardless, as long as you take care of it. I know many people that bought a homes and sold their homes, and they got way more money than they put in it because they gained equity. Yep. Renting doesn't mean you're throwing away money every month, and owning doesn't mean always help you build wealth in the long run. So it's kind of really on what you want to do. If you rent, it doesn't mean you're throwing your money away, give it to making somebody else rich. And if you own a home, doesn't mean you're going to get rich. Like you just got to understand your situation and do what makes sense for you and your family.
All right. First time home buyers loans and programs. So this is the FHA loans. So those are loans backed by the Federal Housing Administration. These are the loans that people will say that they can just do 620 minimum credit score. But as you saw on the report, that can still hurt you. Okay, so I digress. So just 3.5% down, making them a popular choice among the first-time home buyers program. According to most recent federal data, don't talk about me if you watch this webinar because I can't see. 73% of FHA borrowers put down less than 10% for their loans originating in October and November. That was back in 2021. However, if your credit score is under 580, you would be required to put 10% down. Loan limits will vary depending on where you live, with maximums ranging from $420,860 to $970,800 for 2022. Now, what I can tell you is that in most states, from my research, what I've seen, FHA loans do not go beyond $500,000. And you want to be in that range to put the least amount of money down. And they also have grants to be able to help you with down payment assistance on your home too. And if I'm not mistaken, you do have to pay your own closing costs. So I just want to throw that in here. A credit score in the 500s can qualify, and approved borrowers, tend to have a much higher scores. From January to November 21, the average FHA borrower had a credit score of 678 according to the data. FHA loans have an upfront ongoing additional cost built in, which is your mortgage insurance premium. So all mortgages have that, but theirs is built in. This protects the lender's stake in the loan if you default.
Exactly.
Yep. And VA loans, of course, they are none. They don't have a down payment.
VA loans are the best.
Yes.
They're the best.
With the military connection, great for vets. Often these loans require no down payment or no mortgage insurance. And the standard VA loan limit is $647,000. Yes, $200 for 2022. Though high cost areas can have limits high as $970,000. Then you got the USDA loans, which offer finances on rural properties with 0% down. This may surprise you, but the U.S. Department of Agriculture has a home buyers program also, and they also have assistance. And no, you don't have to live on a farm to get it. They do target the suburban areas. Basically, there are income limitations which vary by region. So all of these have limits vary by your region, location, your income, if you earn too much in income, you can't qualify for a FHA loan. You just can't say, hey, but this is my first time buying a home. That doesn't matter if your income says that you do not qualify. So just look at the qualifying criteria to see where you fall in line with any of the home buying programs or loans, because you may qualify or you may earn a little too much to qualify.
Right. And some stories I have heard is people wanted those FHA loans,
Yeah.
but the home they wanted was outside of the limit. So they had to come up with the difference to get that FHA loan. All right. First time home buying loans and programs. So Fannie Mae and Freddie Mac loans.
Yeah, those are conventional.
Those are conventional loans with just 3% down. Fannie Mae home loan with Fannie Mae home ready loan. For example, designed for low income borrowers.
That's not
And this ain't my
ours.
first language. This
That's
ain't my
why-
first language.
That's why I say rural.
With credit scores of 620 or higher, or preferably a 680 or higher, and requires only 3% down. One advantage of this kind of loan is that word again, borrowers, could qualify to end their mortgage insurance once they have built up 20% equity. So if you're doing a conventional loan, if your home can get 20% of equity, you can cancel your private mortgage insurance.
Yeah.
People loans have went down $300 and $400 a month by getting 20% of equity. So I'm gonna tell you how you do that if you do a conventional loan only. So this is only conventional. You either double up the payments and try to get to the 20% of equity in your home, or you catch the market when it's hot, you get an appraisal. And then once you get that appraisal, it lets you know that your home equity went up to your loan value. So that means if you bought a home, let's say if you bought a home at $100,000 3 years ago, and now you get it appraised and it's worth $180,000. Well, that new appraisal is how much the home is worth now. So your mortgage lender has to honor that to give you the new equity in your home, meaning you can cancel your PMI insurance.
Yes.
Unlike FHA loans, you can cancel the mortgage insurance after 11 years. Yep, 11 years. So you can cancel your mortgage insurance. That's the good thing about conventional. Unfortunately for us, we had to go conventional, but it was a great thing because we learned a lot about conventional buying our first home. And we're going to tell y'all some more tricks about buying your first home as a couple as well. Same thing about conventional. It's the same topic as the last one. All right. So understanding your debt and how it affects the home you want to buy. So I'm going to go in this. I'm going to let Keisha jump on it too. So the first tip is you purchase this course. You'd already purchased it. You got it for free. But this is a part of a course that we do include. It's your advice. It's my advice to you to make your best financial decision when buying a home. Do your own research. We know bad, but here's some upfront advice. Couples, you need to keep your credit separate. If you are in a relationship, situationship, entanglement, marriage, I don't care what you are in, you should keep your credit separated when it comes to making serious purchases like this. Why?
Many, many reasons. Our reason may differ from yours, but our reason is that if anything happens in life, unforeseen circumstances do happen, life is real. We can always use my credit, vice versa, but we can't use yours now. We use this for everything. But when you keep your credit separate, it allows for the other spouse to be able to do other things with their credit. If you want to use their credit for a business, for investments, unforeseen circumstance may happen, a bankruptcy may happen, anything may happen, but the other person's credit is free.
And I'm going to give you all a perfect example. Ideally, people are going to buy their first home about $200,000. Well, that's one person with $200,000 on their credit. Well, say a person B get that same loan on their credit, so they share the loan. Now you got a total of $400,000 in debt as a household. Meaning, if I ever get a late payment, she gets a late payment. If I ever foreclose, she forecloses. That's why we say keep your credit separate, because if I get a late payment, it does not affect her. If I happen to foreclose, we can use her credit to get another home and it won't affect us. But so many couples think that it's such a bossed up goal to do. The real bossed up goal is use your credit to both help y'all succeed. You get a home, she get a home. You use it for a business, she use it for a business. Like do it separate so you won't be tying your credit in together and causing yourself double the trouble if something bad happens.
And I've talked to a lot of women who, I want to buy a home with my husband. Okay, well, we both need our credit fixed. Okay, so both of y'all are going on a mortgage loan. Well, let me just share this with you. You and your husband's name is still on the property if you're married. So his name is on the mortgage with the lender to actually get the funds to purchase your first home. And your name will be listed on the deed with him at the time that you go and sign your papers at closing. So it's not a one-person deal. A lot of people feel like they'll be left out if their name is not on the mortgage. And you won't be left out. It's still your property, just like whatever we have that's in Sarah Belong's name, we're married. So just don't look at it that way. Stay positive and keep it separate so that you can grow more. You can grow more quicker and faster without having all of that debt hanging over your heads.
And in Tennessee, you can apply for a home in both couples' names don't have to be on it, right? I mean, when you do the loan, but
on those states, like if you're married, you don't have to.
Both couples' names have to be on the loan, but you can put it on the deed, right? So yeah, you can add your name to the deed, but you don't have to be on the loan, so you don't have to.
Just like with our situation.
Okay.
I'm okay with that. I think he was okay with that.
Yeah. I'm good with it because it keeps us from hurting ourselves in the future. Unless you have to apply to buy a home unless you have to apply to buy a home, try to pay your car off first or refinance it to get a lower interest rate. So, how to tell y'all this? $100, only $100 can determine $80,000 in purchasing power on a home. Meaning, if you was looking at a house and they told you all you was approved for was $200,000, but you saw a home that's worth almost $300,000, you might need to look at your auto loan and see if you can get that debt refinanced. Because so many people have auto loans, they buy them when they got bad credit. I don't know why people go get a car when they got bad credit, have 14% interest. But if you can refinance that debt, you probably can get a $300,000 house and stay in a way better community for you and your family. So think about that when you're going to go buy a home. Either pay that car off or refinance it, because that will help you a lot if you can do it. Credit really matters. It is also optional, but in today's market, the higher the scores, the better the interest rates for a home. You will probably pay for 360 months, which is half of a lifetime. You may want to have the best scores possible when you buy a home. I can't stress that enough. When it comes to buying a home, you want to have the best scores as possible. If not, you're going to put yourself in a messed up situation. And that's it for that. So I want to share something with you all. Many people have been asking about this. Hey, we're back again. Shine the screen. So we do have a link tree that we're going to link with this, and we got a lot of awesome products that we always added. Many people say that credit repair itself is too hard, and they rather they say it's a very challenging. If you can't go straight to the link, which you should be able to, you can copy and paste it. But many people say that credit repair is too hard, and they just can't get with it, or they have all types of excuses. I really don't know what it is. If you want help with your credit, we do offer a free credit repair service. We do charge for education only, so you can get your credit repair done for free. And if you want to save money, we got this killer credit repair course that we put together that comes with a lot of these same tips that we just went over. And you can save up to 50% using the Black Friday promo code. So this is good for the end of the year of 2022. But you can use this code and grab this killer course that we put together. They go to us again. Ooh, it's so good. Okay. But these are some of the benefits you get. We do have a Metro 2, the Spirit Letter package to come with it. And you get a book. You get a book. You get one of our credit books. Yeah, if you want to order that, you can order you one as well. Get a physical copy, have it around for you and your family. If you're looking for other things, maybe you want to, order our credit repair book. You can go straight to Amazon and place your order there. You click on that link. If you have a business, you can get a business credit analysis, book an appointment straight with us. And we have a way you can start building your credit with credit building Tradelines. So with that link posted, you can just go there and do some exploring. You want to talk about your personal credit, we have ways you can talk about your personal credit. But we are solely here to help you reach your goals, and we will be adding more to it as things continue to go on. Website loaded pretty slow. With that being said, it was a pleasure having you all today, and looking forward to having more meetings with you.
All right, bye.